Let me show you the single most important number in the US stock market right now, 39.2. This is the current value of the Shiller CAPE ratio. In 155 years of US stock market history, there has been only one time when this number was higher than it is today. The peak of the dot-com bubble in the year 2000. That's it. It's even higher than the eve of the 1929 Great Depression, when the CAPE stood at 32.6. What is this indicator? Why does it matter? And what is it telling us right now? Let's dig into the data. First, let's understand what CAPE actually is. It's simpler than it sounds. What's the most basic way to judge whether a stock is expensive or cheap? The PE ratio, price divided by earnings per share. It tells you how many years of profits you're paying for. But there's a problem. Corporate earnings swing wildly from year to year. In a boom, profits are inflated. In a recession, they collapse. So a standard PE ratio makes stocks look cheap at market peaks and expensive at market bottoms. It's a mirage. Nobel laureate Robert Shiller solved this problem. Instead of using 1 year of earnings, he uses the average of the past 10 years adjusted for inflation. CAPE stands for Cyclically Adjusted Price to Earnings. It divides today's price by the 10-year average of real earnings. By averaging across booms and busts, it gives a much clearer picture of whether the market is truly expensive or cheap. Here's an intuitive way to think about it. A CAPE of 40 means you're paying 40 times the 10-year average earnings. You're essentially prepaying 40 years of profits up front. A CAPE of 10? You're paying just 10 times average earnings, a much more reasonable price. The historical average is about 17. Today's 39.2 is 2.3 times that average. Now, you'll hear me use the word percentile. Let me quickly explain. The 98.7th percentile means that if you line up every monthly CAPE reading over 155 years from lowest to highest, today's value is higher than 98.7% of them. Only the top 1.3% of readings in history have been higher. We are near the all-time extreme. Now let's look at the history. This is the CAPE ratio from 1871 to today, 155 years of data. As you can see, CAPE has exceeded 30 only 3 times in history. Just before the 1929 Great Depression, during the late 1990s dot-com bubble, and right now. This leads to the crucial question. When CAPE is high, do future returns actually suffer? The data gives a clear answer. If we plot each month's CAPE value against the actual real return over the following 10 years, a striking pattern emerges. Higher CAPE consistently leads to lower future returns. The regression analysis shows an R-squared of 0.27. That means CAPE alone explains 27% of the variation in subsequent 10-year returns. In the investment world, a single indicator explaining 27% is remarkably powerful. Plugging in today's CAPE of 39.2, the model predicts an average annual real return of negative 2.6% over the next decade. After inflation, your money shrinks. The prediction range is wide, from negative 11% to positive 6%. But the central estimate is negative. Let's break this down by range. When CAPE was below 10, the probability of a negative 10-year return was just 5%. You almost certainly made money. Between 10 and 20, the probability was 15%. Still safe. Between 20 and 30, it rose to 30%. Between 30 and 40, nearly half, 49%. That's where we stand right now. A coin flip. Heads, you earn a positive return. Tails, you lose money over the next decade. One caveat. Most of the data points above CAPE 30 come from the dot-com era, so the sample is limited. But the systematic trend of rising CAPE leading to higher probability of negative returns is supported by the full 155 years of data. Now comes the pushback. This time is different. It's been called the most expensive phrase in investing. But let's be fair, there might genuinely be new factors at play. Let's examine the four most common arguments. Argument 1. Corporate profitability is structurally higher, and AI changes everything. This is the strongest counter-argument, so let's give it the attention it deserves. Apple's net margin is 25%. Microsoft's exceeds 35%. These levels were unimaginable in previous decades, and this isn't just a tech story. S&P 500 profit margins have doubled from 6% in the 1990s to over 12% today. But the real game changer is artificial intelligence. This isn't hype. The numbers are staggering. NVIDIA's data center revenue exploded from $15 billion to over $115 billion in just 2 years. Microsoft's AI-driven cloud revenue is growing at 30% annually. Meta is spending over $60 billion on AI infrastructure in a single year. These are not paper profits. This is real cash flow. And here's the critical point about CAPE. CAPE uses a 10-year average of earnings. The AI earnings boom is only 2 to 3 years old. That means CAPE's denominator is still dragged down by 7 to 8 years of pre-AI earnings. CAPE may be structurally overstating how expensive the market really is right now. McKinsey estimates AI could add $4.4 trillion annually to global GDP. Goldman Sachs projects AI could lift S&P 500 earnings by 30% over the next decade. If even half of that materializes, today's prices could look reasonable in hindsight. This is a legitimate and powerful argument. AI may be the biggest productivity revolution since electricity. And unlike the dot-com era, the earnings are real, not speculative. So here's the honest answer. AI genuinely makes CAPE less reliable as a comparison to historical periods. The market structure has fundamentally shifted. But, and this is a critical but, consider the earnings yield. That's the inverse of the PE ratio, earnings per share divided by price. It answers a simple question. If I invest $100, how much does the company earn for me per year? The current earnings yield is 3.9%, the lowest in 140 years of history. Yes, companies are earning more than ever, but stock prices have risen even faster. The return per dollar invested is at a historic low. Even after all the AI-driven profit growth, investors are paying more per dollar of earnings than at any point in modern history. In other words, AI has raised the earnings, but the market has already priced in not just the current AI gains, but years of future AI gains as well. The question isn't whether AI is real. It is. The question is, how much of that future has already been paid for? Argument 2. Low interest rates justify a higher CAPE. This is logically sound. When interest rates are low, bond yields are low, making stocks relatively more attractive. Paying a premium makes sense. So I tested it directly. When 10-year Treasury yields were near today's level of around 4%, what was the median CAPE? 15. Today's 39.2 is at the 99.7th percentile for this interest rate environment. That means in every historical period with similar rates, CAPE was almost never this high. Even adjusting for rates, the market is at an extreme. Argument 3. The share buyback effect. U.S. companies spend over $900 billion annually on share buybacks. Fewer shares outstanding means higher earnings per share. But CAPE's denominator, the 10-year average earnings, is slow to reflect this effect. Adjusting for buybacks brings CAPE down to about 33. But 33 is still in the top 5% historically. An improvement, but it doesn't change the conclusion. Argument 4. The U.S. dominates global markets, so a premium is justified. This argument might sound familiar. In 1989, Japan made the exact same claim. Japan accounted for 40% of global stock market capitalization, and the consensus was that Japan's premium was structural and permanent. December 29, 1989. The Nikkei 225 index hits 38,916, an all-time high. Japan's CAPE at the time was between 90 and 100, 2.5 times where the US is today. What happened next? Look at the chart. An 82% decline, from 38,916 down to 7,055. And how long did it take to recover that peak? 35 years. It wasn't until 2024 that the Nikkei finally returned to its 1989 level. Now, Japan and the US are different. Japan's CAPE of 90 was far more extreme than today's 39 in America. The economic structures differ, but the lesson is powerful. The argument that our market is the world's largest, so a premium is justified, proved catastrophically wrong in Japan. Let's compare current valuations around the world. The US PE ratio is 27.3, developed market average is 18.5, emerging markets 16, China 10.1. US stocks are more than 50% more expensive than other developed markets and 170% more expensive than China. For the same dollar of earnings, you pay 2 to 3 times more in the US than elsewhere. So are stocks still better than bonds? There's another tool for answering this. It's called the excess CAPE yield. The calculation is straightforward. Take the earnings yield, 1 divided by CAPE, and subtract the real yield on 10-year treasuries. In plain terms, it measures how much more stocks earn for you compared to bonds. When this number is high, stocks are attractive relative to bonds. When it's low, there's little reason to take the extra risk of owning stocks. The historical average is about 5%. Stocks earned 5 percentage points more than bonds per year. Today, 1.1%. The 19th percentile. That's the bottom 20% historically. Stocks are barely earning 1 percentage point more than bonds, yet they carry several times the volatility. The attractiveness of stocks relative to bonds is near historic lows. And here's one more critical fact. What happens if you miss the 10 best days in the stock market? According to JP Morgan research, $10,000 invested steadily over 20 years grows to about $65,000. But if you miss just the 10 best days, it drops to about $30,000. More than half the gains vanish. And 7 of those 10 best days occurred within 2 weeks of the worst days. Sharp rebounds follow sharp crashes. If you exit the market because CAPE is high, you risk missing exactly those rebounds. This is CAPE's most important lesson. CAPE is not a timing tool. It's an expectations adjustment tool. Let's summarize. CAPE at 39.2, the 98.7th percentile in 155 years of history, the second highest ever, behind only the dot-com bubble. The predicted 10-year return is negative 2.6%. The probability of a negative outcome is roughly 50-50. Even adjusting for interest rates, even correcting for buybacks, the U.S. stock market is in its most expensive zone in history. So what should you do? 3 recommendations. First, adjust your expectations. Over the past decade, the S&P 500 returned more than 13% annually. Don't expect the next decade to match that. CAPE is telling you the ceiling on future returns has come down. Second, keep dollar cost averaging. If you exit the market because CAPE is high, you'll miss the rebounds. Missing the 10 best days cuts your returns in half, but avoid putting a large lump sum in all at once. Third, consider international diversification. US PE at 27, developed markets at 18, emerging markets at 16. The same earnings can be bought at far more reasonable prices outside the US. One final thought. An expensive market doesn't mean it drops tomorrow. It means the next 10 years may not be as good as the last 10. In 1996, when CAPE hit 28, selling because it looked expensive meant missing a 100% rally through the year 2000. But in 2000, believing this time is different at a CAPE of 44 meant a decade of negative returns. CAPE is not a signal to leave the market. It's a signal to stay invested, but stay humble. We'll continue analyzing and providing data-driven insights to guide your investment journey. If you haven't subscribed yet, please do so now so you don't miss our future analysis. Thank you.